Obtaining a good credit score is key in not only establishing a money management system where you're efficiently managing your money and also managing different types of lines of credit, but it also allows you to obtain favorable interest rates on various types of loans, saving you money both in the short term and the longer term. And these are skills that the wealthy use to leverage money while paying the least amount of money and obtaining the greatest amount of return on their investments. In this video, I'll discuss different tips and techniques you can use to obtain a perfect credit score for free. These are things that you can start doing right away while not costing you a dime. Get ready. You are now entering the Academy. Now let's discuss the things that credit agencies look for in determining your credit score. First is payment history. The first thing credit card agencies and lenders look for is if your payments are on time each and every month. No late payments or partial payments. Ideally, you want to pay your balance in full and on time so that you're not accruing any interest or debt. Payment history is calculated by taking the total number of months payments were made on time and dividing that by the total number of payments that were due. If all the payments were made in time, then you have a 100% payment history rating. This is also why having more credit cards and or credit history matters, because you have a bigger pool of data of payments made so that your score doesn't suffer if you miss one payment. So for example, for someone with no credit history, if they have one credit card and miss one payment in 12 months, then their credit rating for payment history is 11 divided by 12 or 91.7%, which is actually not good. But someone that has credit history with 6 credit cards, missing one payment in 12 months gives a credit rating for payment history of 71 divided by 72 or 99%, which is really good. Payment history makes up 35% of your credit score, so take this very seriously. After a year of making payments in time, you should see a huge bump in your credit score from this alone. The second is credit utilization. Credit card agencies and lenders want to make sure you are not over leveraging your total credit availability and also using a small percentage of your total credit line. Ideally, you want to be spending less than 10% of your total credit limit available to you. So for example, if you have a $15,000 credit limit and go and make a $5,000 purchase and just make the minimum payments when your monthly statements are due, then you're effectively using 33% of your total credit, which is not good. Under this scenario, you are seen as a riskier borrower, which is considered bad, because in their eyes, you're bad at managing money and cannot handle credit given to you. In general, whatever purchases you make, you want to pay it off immediately when the bill is due. This will result in a 0% credit limit utilization, allowing you to achieve the highest credit score possible in this category. Also, having more credit cards allows for more credit card limit amounts, which will lower your overall credit utilization if you need to make a $10,000 purchase, for example. Credit utilization makes up 30% of your total credit score. The third is credit history. Credit card agencies and lenders want to see that you have a lengthy credit card history. Building your credit card history consistently and as soon as possible is key. Credit history is calculated by the average of your credit history length divided by the number of credit lines you have. So if you opened a credit card, say 5 years ago, and then you open another one today, your average credit history would be 5 years divided by 2 credit cards, or 2.5 years of average credit history. So be careful in opening too many credit cards all at once, because this will lower your overall credit history. Instead, stagger the credit cards once every year or so your credit history doesn't take a significant hit. Credit history makes up 15% of your overall credit score. The fourth is total credit lines. Credit card agencies and lenders want to see that you have credit lines, but not too many of them. The key is to have a number of credit lines to allow you to have more credit limits, which lowers credit utilization if you're making payments on time and barely using any credit, and also a mix of types of credit. Just having one type of credit can actually hurt you, especially if you are over leveraged on that type of credit. Ideally, credit agencies want to see that you have at least 21 different credit lines. Having credit cards along with, say, a car loan and a home mortgage would be better. Even though you may have significant utilization due to your home mortgage and or car loan, it doesn't count that much against you because most Americans utilize these types of credit lines to purchase homes or a car. And as long as you make monthly payments, then your credit score will not be negatively impacted. Number of total credit lines makes up 10% of your overall credit score. Fifth is total credit inquiries. Credit agencies and lenders want to see that you don't have too many credit inquiries. The more inquiries you have, the more riskier you are seen in the eyes of credit agencies, since you're asking for all this credit at one short amount of time, meaning that you're mismanaging your money and need to borrow larger sums of money because you're out of money. Credit inquiries stay on your credit report for up to 2 years and only impact your score for 1 year. So be careful not to initiate too many credit inquiries within a short period of time. The total number of credit inquiries makes up 10% of your overall credit score. Be sure to follow all the recommendations mentioned previously in this video. And those are: check your payment history and make sure you make payments on time. Second, check your credit utilization and be sure not to utilize too much of your credit line on your cards. Third, have a good credit history. Be sure to open new lines of credit once a year to build upon your credit history and make all your payments on time. Fourth, having a good mix of credit lines is good, establishing a healthy history and usage of various types of lines of credit. And finally, fifth, keep your total credit inquiries down. Try not to make too many inquiries within 1 year. Instead, stagger opening lines of credit once a year. Also, make sure to check up on your credit history once every few months to make sure you're on the correct path to building a healthy line of credit and increasing your credit score. Keeping your score above 760 will put you in a favorable position when shopping for loans for homes or vehicles, bank loans, or any other types of credit lines. This will keep the loan interest rates as low as possible, saving you money both in the short term and in the long term. Thank you for watching this video. If you enjoyed watching, don't forget to smash the like button. It will really help out the YouTube algorithm in bringing you more wealth creation strategy videos. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on your notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.